Geez, I really had to think about that.
Thanks for having me back.
Yeah, we're doing it remote, mate. You're in the office. You got the Inside Network logo behind you. I'm in a different type of office. Yeah, we've actually, like, normally when you just sit down and do this, we just talk and we just try and get through every question. We try and smash through them again and again and again. This time we're actually adding some structure to it. So we've been sent a bunch of questions.
Not too much structure. Not too much.
Not too much. Yeah. But one of the things that we thought we might do is just kind of like go behind the scenes. Like, what have you been doing lately before we dive into questions? And by the way, so should mention what we're going to talk about. We've got some really interesting technology companies. We're talking about 60-40 portfolios, leveraged ETFs, equal weight ETFs, US versus Australian ETFs, how to get involved in the investments industry, currency hedging. So there's a bit. But anyway, what have you been working on?
Everything. Business is good, crazy. There's plenty going on in markets, plenty of opportunities. And I think you joined us up in Noosa last week.
You think?
It was Noosa, so who knows?
I was like, the uncertainty there just kept me hanging. Like,
it's not a round table, is it? We ran an asset allocation forum up in Noosa at the Sofitel, and obviously when you go to Noosa, you get torrential rain for 3 days. So allowed everyone to focus on investments and markets. It was pretty dreary and pretty negative ideas coming out of that. But yeah, so some of the leading advisors in the country joined us and heard presentations from a range of groups. Looked at like fixed income, modern monetary policy, what's happening in the UK. We even had a special deep diver kind of explaining how to deal with stress, which is probably important in anyone that's investing at the moment. So.
Yeah, actually went to Peter Kuravita's website, restaurant as well.
All the surveys said that was the highlight of the whole thing.
Really? I thought the diving dude, he was super interesting. How to hold your breath for so long.
Were you the person who, when they get cut off on the freeway, chases down the person in front of them? Or were you
yeah. Definitely. I mean, definitely. But yeah, I mean, it was heaps of fun. So maybe people don't know this, Drew, but what is the Inside Network, right? Like, let's just start with that because people know the Rask brand.
Yeah.
Yeah.
So it's probably a similar version to Rask. It's a community of financial advisors and institutional investors we've tried to build over the last 3 or 4 years. And the entire premise of it is to bring people together to collaborate and discuss and improve the quality of investments and investment management that's going on in Australia. I think maybe that's a Cliff Note version.
Yeah, no, it's super cool. So if you're a financial advisor or you're a fund manager or something like that, it's basically about bringing everyone closer together. And yeah, we actually, I don't know, I think I told you this, maybe not, but we actually aired the first of those recordings with Craig Ferguson. We did that on the podcast. We're recording this on Thursday. We aired it on Wednesday. And Craig is a great example of a guy that was in the crowd at this thing. So he wasn't even presenting. He was just in the crowd and gives you an idea of kind of the depth of knowledge amongst the community. So
some asset consultants, there were some economists, some financial advisors, and broad range of people.
So if you are a financial advisor, you're a consultant, a high net worth investor or family office, you can learn more about the Inside Network on any of the websites like insideadvisor.com.au. Or even just send us an email and we'll put you in touch. But mate, so we did that. Then you flew back to Melbourne. I flew to Sydney and we went and did some filming up there. I did a bunch of interviews with like lots of different people, really interesting people, founders, which they'll all appear on this podcast in the next few weeks. Spoke to even Effie Zahos. She's appearing on the other show, the
Money Mag or
Money Mag, CanStar, InvestSmart. So she's kind of like I think she's on either the Today Show or Sunrise. I should know that, but I don't know. So I met a bunch of really interesting people, and I mean, there's so many highlights that I could have, but one of them was probably interviewing a guy called Wayne Hooper, who's the CEO of a company called LaserBond, which you and I've talked about in passing before.
Yeah.
He's never done a long form interview in his life, and he's the CEO of this company, been there since 1994. So talk about someone that's kind of just remained hidden that whole time. And then we had FinFest on Saturday, which was run by Equity Mates, which was heaps of fun.
You stole my shirt too.
Did steal your shirt. You know what, actually? The reason that I took that pineapple shirt was because I had... See, this is the black Rast top. You can see this on video. If anyone that's watching, not watching, I'm just wearing a black Rast top. But I got about 50 of them in grey. And up in Sydney, because I wasn't washing, I was wearing this and whatever, and then I had to swap. So I went and got the grey ones out, and I was going to take that to the event, but because it was hot, I was like, well, I can't wear this because I'm going to have sweat patches in front of hundreds of people. So then I put the pineapple top over the front, and everyone's like, oh, I love that. So I just kept it going, and yeah, it kind of worked.
It's disarming. It's great.
It is, amongst a room. We did this because we're talking to investment consultants, you and I. We were rocking up in ice cream T-shirts and pineapples and stuff. And it really set the scene for a lot of these really technical people to just chill out a bit.
There's a tendency to take ourselves too seriously, isn't there? That's what you're kind of trying to break.
Yeah. And so it was heaps of fun to even do that. I mean, yes, FinFest was a huge experience, about 1,700 people and lots of good speakers and personalities in the rooms. So yeah, I heard the guys do it again next year, and it was just heaps of fun to meet a lot of people that follow the shows. So keep your eyes peeled. But finally, I might just add, and Drew, I'm throwing you under the bus here because you don't know about this. We are hosting a bit of a meetup in Melbourne in December. So I'm hoping, provided
I'm sponsoring, aren't I?
Yeah, Drew's sponsoring it. He didn't give a choice in the matter. He's sponsoring it. So What Are Partners Financial Planning is sponsoring it. So go and check that out. That'll be in early to mid-December, obviously before the Christmas rush. So it looks like we've just confirmed it will be at the Victorian State Library in the Melbourne CBD. So it'll be heaps of fun at a good place. There'll be drinks, there'll be food, all that stuff. So keep your eyes peeled. But mate, let's get into it. Let's crack on. So we've got a bunch of questions that were sent in. Remember, you can send a question on any of the Rask websites. Just go to the Ask a Question button, link, whatever it is in the menu, and you'll be able to do it there. Select the Australian Investors Podcast. So maybe we'll start with one of yours, Drew. A question that came in real quick was, why would you use an active fund manager over a passive? Or like, would you combine them?
That's the ultimate question, isn't it? So, I mean, a lot of people and anyone, initially engaged with investing just sees low costs fantastic, and finance is probably one of the only industries where you can get the average for nearly free. So, like medicine, you don't necessarily want the average; you want better than average, but you can buy the average for like 0.08%. But the question is, at the moment, are you comfortable with the returns that are going to come from the index? And the index is constructed a certain way. And what we kind of see, there's two probably answers we'd have to this: is the environment we're in at the moment is incredibly different to the one we've seen for the last 10 or 20 years. So interest rates falling have helped every other asset class. There's a chance that some sectors will outperform and some countries will outperform, and that's why you might use an active manager in that part. And then one of the things I noticed this week meeting with clients was with our Atchison business, which I think we've talked about as well. We're getting more negotiating power to the point that we can actually get access to active managers at similar prices to what a passive manager might be, and particularly somewhere like emerging markets or smaller companies where a market cap weighted or a benchmark doesn't necessarily give you the best exposure either.
Would you say, I think we've talked about this a lot, but there's a few different markets where active versus passive is kind of a bit more clear cut. This is something we spoke about with Will Hamilton and Noosa, actually.
Yeah.
So which are some of the markets where it makes more sense to be active over passive?
There'd be a few. Like, I mean, concentration risk is always a challenge. Something like Apple and BHP just dominate an index, but that doesn't mean you can extract that much value from the S&P or the ASX by going active. But definitely smaller companies where there's less research coverage and there's a big, broad, like 2,000 companies in that index. There's room to active, and I think when you look at the S&P data on number of active managers that outperform the benchmark, it actually increases for smaller companies compared to, I think the average smaller company active strategy outperforms the benchmark, where it's the opposite for large cap. Private markets, and then kind of not less transparent, but less covered. So groups like areas like China, emerging markets, where there's significantly more inefficiencies, less research and less companies in the benchmark.
Yeah, I think that's I think there's like two big questions that people know that like they want to have portfolios that are exposed to shares, to property, to whatever they want, right? Bonds. Then it's okay, which is the most efficient expression of this? So which is the best expression, I should say. So when I think about expressions, I think, do I want listed or unlisted? Do I want currency hedge or unhedged? And do I want active or passive?
Yeah.
You can have both. You can have all of those in a portfolio for sure. But which of those do you want for each market, I think, is a key consideration. So for me, I basically agree with everything you said there. Actually, that kind of just brings in another question that we got, which is the 60-40 portfolio. So one and two, is it still valid? Because there was a lot of talk about this amongst consultants, obviously with interest rates being so high, inflation being meaningful. A lot of people are saying that 60-40 portfolio won't work anymore. Bonds are basically done. Equities are in for a slower market. So
I reckon I completely disagree. I'd say it's going to work now better than it did for the last 5 years.
Well, yeah.
That's easy now that bonds have fallen. I mean, the concept is, what I've found is no one actually invests the 40-60. It's just a concept that people bring up to tell you how bad returns have been. So 40-60, the way most people talk about it is that you have 40% of your portfolio is in bonds and just benchmark bonds, so essentially government, and 60% in the ASX 200 or the S&P 500. So it's just putting together two asset classes and what they've done over time. I mean, long term, the returns have been something like 10%, I think, for that. But short term, because both equities and bonds have fallen in value at the same time, it's been incredibly difficult. But I haven't found an advisor or a group that strictly has a 40-60 portfolio anymore.
Right.
Either you're making asset allocation decisions by adding smaller companies or emerging markets, or having some floating rate fixed income, not just buying the index. So
you reckon? So just to confirm, you reckon that the 60 portfolio is like just something that people put up as opposed to
like a reference portfolio?
Yeah, look how much better we've done.
Yeah, exactly. And it's the easiest one to beat at the moment because both parts of it fell. Doing anything different, slightly different, even holding in some extra cash, and you've outperformed. It's a relic of the 70s when it was really initially built.
Right.
And I think most people think more in more detail about how they're constructing portfolios now. Even DIY investors at home, you might add a high yield Australian equities and a Europe versus international, and that just breaks that completely. You've got more diversification.
Yeah. I agree, for what it's worth.
You can disagree with me sometimes.
No, I kind of do. I agree. It's pretty hard to. So if you got like the 60-40 portfolio, right? As a concept, I think the 60-40 portfolio works because it sets the grounding of what probably a balanced portfolio would look like for a lot of Aussies. In that 40% are risk off or like lower risk assets and 60% are growth focused assets. So for me, that's a good starting point for anyone. And even if you're a bit older, like a lot of people think you need to go, to 20% growth assets. Probably it's too low for a lot of people. And so I think as a starting point, it's really good. And I think it's what you do from that. Like you've talked on the show about how you have like 4 different buckets. So you've got, even though it's like 60-40, you would have 2 buckets within the 40 and 2 buckets within the 60. And for me, I kind of lean to that as well. There's this whole thing in the middle called alternatives, which some people have 100% of their portfolio in alternatives. Like obviously, that's not for everyone, but we spoke to some people that just research and just use alternatives, what would be considered alternatives in a traditional sense. And so, yeah, I mean, for a starting point, 60-40 works. I would not, like over the last 10 years, maybe not the last 10 years, last 5 years, its traditional 60-40 portfolio would have been bolstered by the US markets.
Falling interest rates.
But can you do that going forward? I'd probably, like, that would be a pretty scary portfolio to be in right now. Maybe, I mean, I don't want to get too far in the weeds, but I am anyway. Maybe if you think about it, maybe I'm just gonna lose people at this point, but maybe if like the duration risk actually plays out from here, and that maybe government bonds all of a sudden look interesting.
I mean, the whole reason
you know?
this 40-60 portfolio has done well is because, interest rates fell from 7% to 0. And that increased the value of bonds, and bonds basically returned 7 or 8% per annum. And then one bad year and it's, the concept's broken. So I think all these things, when you're building a portfolio, you're never going to just do 2 assets. I think people are more and more thinking about, what asset classes do I want to be more exposed to? What am I still comfortable with technology? Would I like to have more diversification there? But yeah, it's a good starting point as in asset allocation. But no one actually, I don't know any professional or groups that invest solely on a 40-60 anymore.
No, I don't. Although there was some discussion
without changing it.
Without FinFest that you could get away with maybe one stock and one ETF. Maybe.
Depending on your risk profile.
Depending on your risk profile, you have to be off the charts. So, yeah, I mean, really interesting. So if someone asks what a 60-40 portfolio, it's 60% growth, 40% defensive assets. A question that I got through on Twitter, which is a fantastic question, and one I got asked like, I don't know how many times on the weekend. Benjamin sent me a tweet. So thanks, Benjamin. And he just said, "Hi, mate. I hope you're well. I'm keen to get a start in the finance industry as an investment analyst. I'm an accountant, been doing it for 12 years and been investing for a bit over 2 years and loving every minute of it. Just wanted to reach out as I'm trying to chat to as many people in the industry about the way they got started and what sort of advice they would have for me trying to get into the industry. Any advice you could give me, I'd be so appreciative." Well, thanks, Ben. I did actually send you, Ben, I know you know this, but for everyone else, there is a thing that we did not too long ago called the Investor Bootcamp. It's like a free investment program. It was run through this podcast. The Investor Bootcamp combines all of my favorite interviews and all of my favorite books, blogs, resources, and what have you into one Google document. So I'll put that link in the show notes. But I got asked this question a lot on the weekend, Drew. Obviously, we're pretty fortunate, you and I, we can come on here and record some podcasts, and a lot of people like to listen to it, which is fantastic. And people want to kind of like emulate not just the podcast, but also what we do for a living. I guess for me, there are probably 3 things that I would do to try and stand out from the crowd. The first thing is I would try and publish something. So I would just try and create some type of repository or archive of my thoughts, because an employer wants to know if they hire you as an investor that you understand investing. So what's the easiest way to do that? Just prove it. And so you can start a blog, you can jump on Twitter and try and find people and communicate. You can do threads or deep dives. And other ways, you can join Strawman. Strawman's that free website. It's got a premium version as well, but it allows you to post your research and communicate with others. It's created by Andrew Page. An extra thing that I would do is I would probably try and use things like Twitter to try and engage with financial experts on their level. So this is something I was trying to emphasize on the weekend, that if you want to catch up with a fund manager or you want to hear from them, you want to talk with them, whatever, it can't be a cost to them. Like, it can't be like they're helping you out all the time. So what you've got to do is basically offer them value. And one of the ways you could do that is you could publish some research on a company. Don't do buy, hold, sell because of the advice rules, but maybe just publish some thoughts on the company. Let's say what we're talking about today, TechnologyOne. And you publish that, and then you go on Twitter and you see if there's a fund manager that's talking about it. You can engage with them in the conversation, be like, "Hey, I've written this up," and blah, blah, blah. Don't try and sell them on it, but just let them know that you know what you're talking about. And then eventually you might go, "Do you want to catch up for coffee, or do you want to exchange notes or something like this?" And it's a really good way to communicate with them on their level. And I think sorry, mate, go on.
And find where your interest is too. Like, some people like technical. I hate technical. Some people like fundamental. Some people would say go and read Benjamin Graham's, Intelligent Investor and all these books. But most of them, they're great books, but not necessarily relevant to the environment we're in at the moment. So where's your interest? If you're not interested in certain parts, you're never going to, dedicate the amount of time you need. It's almost finding your niche in all business, finding your niche and trying to leverage and dominate that niche.
Yes, agreed. Because you've got to stand out in the crowd, right? So
everyone's going to have a CFA. Everyone's going to have a diploma of advanced applied finance. So
you got to, and that's it used to be the case that there's a chart that shows stock CFAs per stock in the United States, and it's just going up and to the right, like the number of CFA charter holders there are to the number of stocks, and it's ultra competitive. I think as a an accountant, to Ben's question, he's got a very unique insight in that he's been working with a lot of private businesses.
Yeah.
And I would, as an investor, I would probably try and use that as an advantage and try and find investors that are involved in private markets.
Yeah, definitely.
That's a huge advantage, because private markets, we've talked about this 101 times, is like a frontier for a lot of private equity firms, for a lot of listed investment companies, for all these different types. So it's great that you want to get involved in the industry, Ben. Keep it going, build that network. You're doing the right thing. Drew, would you do, if you were doing, you're obviously chartered financial plan, certified financial planner. If you were to do your time again, would you do the CFA or would you stick with the CFP?
I tried. Is this another one putting me in it?
Yep.
I tried, was unemployed, failed miserably, only passed one part of the exam. But yeah, I think if you want to be in investments, we engage other groups to help with the real detailed, and they're all CFAs. But if you want to be really deep in investments, you have to commit to that. Incredibly hard though.
Yeah, super hard. I'd probably try and stand out in other ways, to be honest. I would
do a PhD in biochemistry.
Yeah, then just work for some sort of life sciences investment company. No, but seriously, I think if I was to do my time again, I've said this before, I would learn commerce, but I would also try and learn some other skill. Not only as a plan B, but also just as a variant perception on what's offered in the market. So, a lot of investment banks and that type of stuff want you to have things like law degrees or engineering or whatever. We actually just had a question come through live, Drew, from Martin, saying, like, with the defensive side of a portfolio, keep money in an offset account versus a home loan versus government bonds. Does it make sense? I think so.
It depends on if you've got outstanding debt and your interest rate's going up. Yeah, then generally not personal advice, but
not personal advice.
You got to make that a call. And then is it non-deductible debt or deductible debt against investment assets? That's the other question you'd ask.
Yeah.
But yeah, the way we'd see is, and the interest rate, if you're putting money in an offset account against an interest rate, that's a guaranteed return equal to the interest rate plus the tax that you'd save on making that payment. So
yeah,
you don't get many guarantees.
I've talked a lot about this recently. Like, we still don't know what interest rates are doing. So on a bond portfolio, you still don't know for sure if you're going to expose yourself to higher interest rates. So versus an offset account and a term deposit is probably the next thing after that. Like a term deposit, you can get a 4% term deposit, lock it in for a few years.
Yeah.
Like, that makes sense. That just makes sense. So for a lot of people that are in retirement, so basically it goes like this. If you have a mortgage, you can use an offset account. If you don't have a mortgage but you want that, you can look at doing a term deposit, because you have no, what we call, duration risk. And then we kind of do, but let's not think about it. And then thirdly, you might look at like alternative fixed income sources. So like low duration fixed income. And then finally, like way down the bottom, you've got government bonds. So
people will say inflation though, and the challenge of inflation, it's 6% at the moment, but honestly, I don't see it being 6% for the next 10 years. So if it goes back to 2 and you're getting 4 or 5 in a term deposit, well, that's actually pretty solid. If it's still at 6 and you're technically losing money on it, then but I can't see it staying elevated for that long.
Yeah, you would have. Persistent inflation is probably a different question. I don't have really the expertise to make a forecast on that, but persistent inflation is probably something that people should be mindful of. But whether it stays at these levels is a different question. Thanks, Martin, for that question. Okay, so we've got some questions that have come through. Some great questions. I might just really quickly answer this one. Dog On says, why doesn't Liontown Resources get more love? Long-term investment. That's because Dog On It. Dog On It? Yeah, Dog On It.
Dog On It.
Yeah, Dog On It. That's because this is a very kind of like speculative company. A lot of these lithium style companies and any type of company that is involved in exploration and mining is kind of at the pointy end. So the difference between basically everyone and Pilbara Minerals is that Pilbara Minerals is super cash flow positive, and everyone else wants to be Pilbara Minerals. So
and this is just a momentum. When lithium's running, everyone will jump into this. There's a lot of momentum in day trading and shorter term kind of signal trading that tends to drive markets. That's why it fluctuates massively. I say that's why people don't like it as much, because it's so volatile most of the time.
Yeah. So there was actually one thing that I was going to just put you on the spot, Drew. I feel like one of these days you're going to put me on the spot. I think
I'll try.
Maybe you have once.
But I did when we're in Noosa.
Yeah, yeah. They're just in the deep end talking about like bond convexity, and I'm like, oh god, change direction. So there was I ran a screen on the ASX, and I was looking at self-wealth data for this too, thanks to our sponsors at Self-Wealth, $9.50 trading. So I was running a screen on the ASX, right? This is the screen. So it can't be speculative, like tiny little micro caps. And that there has to have a positive return on investment. That's important because then you exclude all like the lithium stocks and stuff that are nowhere near profitability. Which I'd be interested to know, can you name any one of the companies over the past 10 years that would be in the top 5 based on share price returns?
Wesfarmers?
No. Think like, I'll give you a hint actually.
BHP?
3 out of the 5 are technology, and 2 out of the 5.
Oh, that narrows it down.
And 2 out of the 5 are financial. So 2 out of the 5 are financial, and 3 out of the 5 are tech.
You are putting me. I'm getting embarrassed here. Well, if it's tech, it's got to be like car sales, realestate.com.au, WiseTech.
Oh, close. WiseTech was close. Not quite WiseTech. The thing is, though, not quite Appen. Altium, I think, is the one. Yeah. See, the thing is, all of those companies were already big 10 years ago. Well, not already big, but they were meaningful.
And they were scaling in terms of cash flow. Yeah.
So financially, they're probably the best performers. But in terms of stock price, we've got Altium, Pinnacle Investment Management.
Scale.
Yeah. Polynovo. And this is one that 24. I think this one you own, which is Australian Ethical.
Oh yeah, not Zip.
We don't talk about that on the show anymore. And then Objective Corporation, which is
we shouldn't talk about Australian Ethical too.
Yeah. And so that was really interesting to look at those companies.
That's really low cost of business, really, and you've got scalable. Pinnacle and Australian Ethical. Essentially, your expenses stay flat, and as your assets go up, you can make more money.
Absolutely. What I found was really interesting about these companies, it's when you get to number 6, it's really interesting, which is Dicker Data, which does like IT sales and all that sort of stuff, which is a more capital intensive business. And you keep going down, there's some other names in there like Aristocrat Leisure, businesses that you wouldn't think are capable of like 1,000% returns over 10 years, but really interesting list. Anyway, 2 of the companies that we got asked about, I'll bring them up now. So this is from One Up on Bridge Street, which is a great name. It's a play on Sydney and on Peter Lynch's book, One Up on Wall Street. They say, really enjoy this.
Bridge Street in Beechworth, no? I wasn't
Beechworth? Sure. As in Beechworth? Is Beechworth like rural Victoria?
Yeah.
Okay, I don't know.
Oh, that's Bridge Road. That's Bridge Road. Yeah. I've got beer on my mind. It's 4:40, so.
Yeah, it's 4:40. Really enjoy listening to you and Drew. I have a small portion of my portfolio dedicated to individual stocks. 2 on my watch list are TechnologyOne, TNE, and Objective Corp, OCL. I'm interested to hear your thoughts on what differentiates these 2 from another and which you prefer longer term. I'm happy to riff on this unless you have anything to go on.
No, I tend to not stray outside the 200, so I'll just cherry pick what you say.
Okay. Well, Rodney's did just say live on YouTube, he said it's Bridge Street where the ASX lives. Thought so.
Not Beechworth, right?
Not Beechworth. Okay, yeah, Objective Corp. So it does. We've spoken about this with Claude Walker on the show before. Objective Corp, one of the ASX's best performing companies. It's number 5 on my list of the best performers over the past 10 years. Objective Corp basically does software for councils and for corporates and that sort of stuff. If you've got like document management, if you've got planning, anything like that's involved in kind of like the bureaucracy, you can use Objective Corp. And it's run by CEO Tony Wells, who I believe owns about 65% of the company. Return of invested capital over 35%. Been run for a long time, used a combination of acquisitions and organic growth. mission critical, because once you get into one of these councils or whatever, they're not gonna take it out. Like, there's so much inertia to keep it in there. So insider run, that's probably the big. I guess it's like for some people that's a green flag, and for other people that's like a bit of a red flag when it's 65%. That's a lot of inside ownership. So you basically, it's him against the world kind of thing, because there's so much control there. Now, how does that differ to TechnologyOne? So TechnologyOne it's got probably the most enviable track record on the ASX over the past 30 years. It's been growing revenue, earnings per share, and cash flow for the past 35 years, I think. It's got a return on invested capital of 45%, which is fantastic. It's actually number 15 on my list on the ASX's best performers. So it does enterprise resource planning software. So software for basically everything inside a university or some sort of corporate in Australia and the UK. It's so mission critical. When we talk about software being sticky, it's got, I believe it's about 99% retention.
Yeah.
So imagine being a business and you keep 99% of your companies.
And if you're going into small caps, this is the kind of companies, maybe they're not that small, but these
Not
are
anymore, but yeah.
3.8 billion still, mid cap, global mid probably.
Yeah.
These are the companies you want, companies that pick a sector and don't dominate it, but have a real say in that sector and specialize somewhere. You don't want them trying to spray multiple sectors and be ultra competitive with too many different groups.
Yeah, like the big tint cans of the world. I don't know if you know that business, but you want to have a business that kind of, like, if it doesn't dominate, it's like a winner in one of these industries. So the big change for TechnologyOne is coming from the push to the cloud. It's kind of like Data 3, if you know that business. It's where it's shifting clients to the cloud, and that brings with it SaaS revenue, so subscriptions. But it also brought with it a change of accounting, which a lot of people didn't like at the time. So you could look at the capitalized software. I think it was around about 2018, 2019. You look at the change in the financials, there's a meaningful change, which made it hard to kind of test that over time. Recently, the executive chairman, who was a co-founder, stepped down from the board, and he's going to take his large sum of money and go invest in venture capital. Still got one founder involved in the business, if I'm not mistaken, as a non-executive director. And the CEO has been with the company for a very long time. He actually was promoted internally, which is what I like to see. So long story short, the businesses are super impressive, still growing, got a long growth runway, insider ownership and alignment. They just come with a price tag. They're just, both are quite expensive.
Pretty big PE, yep.
Yeah. So you just got to make a decision. You've got to have these companies on your watch list and be ready to pounce. For a very, very small position, I kind of like to take a very small position in these types of businesses, because it's kind of like a buy-in. It's like a research stake. Like, you buy a little bit and then it keeps you engaged. I was chatting to Nathan Bell from The Intelligent Investor, another sponsor of the show, the other day, and he believes that there's only 10 to 15 truly exceptional businesses on the ASX. I don't know if either of these two are in his list, but for me, they would be probably in my 10 to 20 best ASX companies. Just because of the quality of the financials, basically no debt, net cash, fortress-like business models. So
you have to pay for it. That's the challenge. And you put it on your shopping list and hold off. And the question, we're just talking to someone at like global multi-asset investor, and the challenge at the moment is your risk-free rate. So the value on which everything's discounted has gone up significantly. A lot of stocks have gone down 70%, even though their cash flow is increasing. So the assumption is that if you're growing fast enough, you can offset the increase in the risk-free rate, but you don't know. So it almost takes a while for it to flush out, particularly when it's so insider owned that you're not going to see the amount of trading that would result in a significant change in the valuation.
Yeah, and that's it. So we've seen TechnologyOne just keep going up throughout this whole time, whereas Objective Corp's down 31% over the past year. I would be starting to lick my lips at Objective Corp maybe once it gets down towards $10. So that's not a price target, by the way. It's just me saying, like, as it gets down towards that, like, that's where it gets more tempting. Still got a PE ratio of 66, so you've got to justify a lot of growth, especially now when markets are volatile. So something to keep in mind. Actually, Drew, before we get to the next question, we just had some real quick follow-up from Zeddy. I said, how much financial modeling from your studies is used in investing? I heard Buffett never used a DCF, etc. Could you elaborate on this point? I'm happy to field this if you want.
Yeah, I mean, we employ asset consultants that do a hell of a lot of financial modeling to help build portfolios, and then rely on a lot of external research as well. So we don't do a lot internally we'll do, asset allocation and scenario analysis using tools, but I'm not building much on Excel spreadsheets anymore.
I'm obviously a bit more
Or Python, isn't it? They use Python or something like that.
Python for like systematic stuff, but I'm a bit more in the weeds than Drew, because obviously Drew, being a financial planner, is mostly focused on like building wealth for clients and portfolios. I do that too, but in a different capacity. I also love my individual stocks, like the last question that just come through from one up on Bridge Street. I reserve a part of my portfolio just for individual stocks because I love it. I love businesses, basically. And so financial modeling, Zeddy, so I still like to crack open a spreadsheet and do a bit of financial modeling. Like, I like to understand the model, the way the margins will go over time, if the business can scale. I like to get that confidence in the financials too. Doing a DCF is not the holy grail. I think everyone that knows how to use one will say that. But what it does for me is it forces me to check things. We've also got a checklist. I don't know if that's available for free, Zeddy, but it's definitely inside our Rask Core membership. $9.99 a month to just pitch it to you. But I think that the checklist is available in there. So
it's only one part too. Yeah. Sorry.
Yeah. Sorry. Yeah. No, I agree. It's only one part. Like, of all I would spend more time doing the checklist and more time doing the actual just reading for sure than I would actually modeling.
I've seen so many people who can get the revenue, their margin down to the perfect point, and then the stock will fall 40% because of a hedging decision that the bank, or because management, or some bad corporate decision. So you can get all the modeling right and still have a bad investment. That's what the challenge is. That's why it's always art and science, not art or science when it comes to investing.
Yeah, most of my work, and I think most of people's advantage in investing, and this is particularly true for long-term investing, is not in the numbers.
Yeah.
Because you'd be much better off getting the business right than you just even being in the general vicinity of like revenue in 5 years is really good.
Yeah.
So the only way you're going to get to that is if you know the business and the industry inside out. And that's why I like now, as a change in philosophy, I like to focus on between 5 and 15 companies and know heaps about those companies, rather than, is heaps a Kiwi term? Let's bring that in. Sorry for anyone watching from the States. So I would rather focus on that than just try and have a view on everything and try and DCF everything in the universe. Like, it just doesn't make a lot of sense to me. Anyway, great question. Next question comes from Ron Burgundy.
So someone of my vintage, clearly.
Yeah. Hey, I love the show. Yeah. What does San Diego mean? No, that's not the question. So Zeddy, you've said, really appreciate the response. As a uni student, this really helps. Wonderful, Zeddy. Great. Oh, just so you know, Zeddy, you can go to the Rask Education website. Let me know if you are a student. I'll give you a pass to our Value Investor program. Just send me an email via the contact forms. That will sort you out, as well as that Investor Bootcamp that's in my Twitter bio. So, hey, legends, says Rod Burgundy. Interested on your thoughts on the ETF by Vanguard VAE. I'm currently using it for some diversification into Asia. All caps Asia, though, so I don't know.
That's also a Betashares product, isn't it?
That's also an ETF, so I was a bit confused. So, am mindful to keep my position size small at 5%. Performance has been poor over the last few years. Is this an ETF you would use for Asian exposure?
Personally, we tend to prefer the iShares IAA, which is the top 50, but you're not going to go too wrong. You're buying an Asia index ex Japan as a kind of core exposure. The difference is, I think that holds either 200 or 1,000 companies, where the iShares Asia has 50. So you've got a more concentrated exposure. So TSMC, for example, is like 10% of the iShares versus 3 or 4 in the Vanguard option. I mean, generally, we have a couple of tilts in our asset allocation, and Asia is one of them. It's quite lonely there at the moment. But the way we talk about it is, if you think 10 years from now, where's the growth in the global economy going to come from? It's clearly coming from Asia. And how do you position for that? And I know one of the biggest impacts on the sector or the region at the moment has been the strength of the US dollar. So stay patient. It's probably
I would say. So I'm just going to disagree with you for the sake of disagreeing with you. I would no, but actually, I actually think that for a lot of this stuff in Asia, I would prefer active management, to be honest. Not, you can have both for sure. We say that on the show all the time. But I just think, like, I don't know. I just prefer strong property rights. I prefer strong governments, stable governments. I
Finding
might,
an edge.
yeah, and the ETF. It's not an ETF. Got to stop saying that. It's not an ETF. It's a listed fund. It's the FEMX ETF by Fidelity. You can buy it. I said ETF again. Managed fund. You can buy it on the ASX. It's more concentrated, 40 to 50 positions. Again, you pay an active fee of just under 1%. That ETF, geez, I just said it again. Managed fund, I'm going to get this right. That managed fund, I think, is down a handful of percent over the past year. Whereas we look at this Vanguard fund, not chasing performance, obviously, but down about 18%.
I think you had a trick question on me there, because I said, "Is this the ETF?" And you've said it's not an ETF.
Well, the FEMX it's a fund.
We could have changed the question before it came up. I mean, generally kind of agree, because we've had a core low cost, but one of the benefits of the Atchison Consulting Group we own as well is the ability to negotiate discounts to fees. So we can actually get access as advisors to some of the active managers at a cost that's much cheaper than, or not cheaper than, but closer to passive than what it normally would be.
Yeah, right. Okay, so it turns out I wasn't quoting the last 12 months fee returns. I was quoting the last 3 years. So for FEMX over the past 3 years, the fund has returned 2.63%, whereas Vanguard total return over that time is 0.7%. Both of them have been smoked over the past year. Yeah. ETMF, exchange traded managed funds, says Rodney. That's right. I'll just try and get that into, and we're seeing more of these things come to market too. Active managers really wanting to cash in on the exchange traded products. So we'll probably see more of this happen.
There's so much inefficiency in China, India, Asia. So there's room for, I think, active and passive, definitely.
I just think, so this is my gripe, right? Like with the whole China, Taiwan thing, I don't want to see anything happen there. Obviously, as a concerned human citizen, I just don't want that to happen. But at the same time, even if that doesn't happen, China has shown over the past 5 years that it's going to bring down some of these big companies that get too powerful anyway. So, Alibaba and all that. I just feel like, I don't know. That's a very uneducated view on it. I just think that I'm quite happy just to use my US companies as an exposure into the world markets, I guess. That's just
I hate that.
What do you mean?
If there's companies that are going to get hit more, it's going to be the US companies operating in China rather than the Chinese companies operating in China.
I agree, but at least you still got something after the fact. You still got a US dollar denominated company that will have operations around the world.
Then the US dollar devalues, and then you're in much bigger trouble.
True.
Next question.
Next question. Okay, we'll take this off here. So next question from Adam from Collaroy. Is that a place?
Well, there was Sausage Sizzler in there too.
Oh yeah, Sausage Sizzler. I continue to hear about Infratil. Is it an infrastructure utility or healthcare company? I don't know much about this, but you did riff on this a few weeks ago.
It's a conglomerate similar to what Westfarmers has been at different points. I don't think you can call it any of them, and that's why it's hard to value. That's why it's expensive. It looks expensive.
Good performer though.
Yeah, owns a bit of everything.
Yeah. So Adam from Collaroy, after your thoughts on using geared ASX 200 and S&P 500 ETFs like Gear and GGUS instead of using the non-geared products. Understood the increased fees and volatility. However, it seems like a great way to stretch your dollar, especially if you treat the investment as at the geared value.
I don't see it as a good way to stretch your dollar. I think that's a dangerous way to think about it. You're leveraging up to 3 times an investment that in an inherently volatile asset class already. I'd say, broadly, these products aren't for most people. I think stockbrokers and day traders, and that's where they're most widely used. It's expensive because you're obviously fees on fees. And the way we've seen them used successfully, you can kind of use a S&P, and we have dabbled, probably the best way to say it, for higher, clients with a tolerance for higher risk would be in 2020, in 2009, when markets, you didn't know they're at the bottom, but when they'd fallen 40%, and you want bang for buck, a lot of your portfolio's fallen, you've only got small amounts of cash, you want bang for your buck, you do it as a tactical allocation with a clear exit strategy, and you try to buy the market at the bottom, and then sell it at some point. But I think you need clear rules on when you're going in and out of these things.
Yeah, I'd say be very careful. Just small positions. I think this is kind of like the engineering brain. It's like, well, stocks do well over the long term. We'll just times it by 2. So, but there's like one of the benefits of actually finding leverage outside of an ETF is actually the tax deductibility of interest. So if you find a way to gear outside of an ETF, you can still kind of get bang for your buck, so to speak, with the I guess the tax deductibility on interest. I'm not saying that you should do that. It's just a general kind of thing that we talk about on the show. If you have a property, it's easier and probably cleaner to get security against the property to invest.
And there's been periods when markets have gone nowhere or negative for a decade as well. We can't forget, yes, generally markets have gone up when you pull right back, but there could be 10, 20 years that they go sideways overall. And if you're doing that, well, that's a really expensive way to get no returns, essentially, if that was the case. So
yeah, it's like the inverse products as well. Those are a different beast, more suited to trading and short-term tactical bets, as Drew said. So Graphine Kid says there has been a focus on lithium, but graphite, says graphene, are a huge part of battery technology. I've been watching Talga Resources for some time. It's a huge potential. Have you considered this area? Would love to know your thoughts. I haven't, Graphene Kid. No.
I had some cobalt. I think it's still sitting there. I'm probably down 70% on it. An interesting company seems to make sense, and then as like all producers, they need money at different points, and then the share price goes up, they raise capital, and they have to raise more. And I think I don't know enough about battery tech, so.
No, I did do just to fill you in and help you out a bit here, Graphine Kid. We did do a show for Self-Off Live with Kanish Chug from ETF Securities a little while back. We talked about all the different players in the value chain. Maybe go check that out. It's on Self-Off's YouTube channel. A lot of these companies are still early stage, so just Drew and I are going to default to, if you do it, be sensible when you do it. All of those things. A lot of people think they come to the stock market with one idea, like lithium, and they come to the stock, they make money from lithium. I saw this thing on the TV. Just be sensible when it comes to how much goes into one of these things. Question, very simple question, Drew, but I like these ones. From this guy. This guy asks, it's like new guy, that thing on TV. This guy asks, what are shortfalls in equally weighted Australian ETFs?
Say, well, one, the fees are higher. 2, it's an active decision, so you're actively deciding to go outside the way the ASX is structured. You're not, it's equally weighted by stock, not by sector, so you're still getting the same exposure. As we said last time, I think you're getting a similar exposure to financials and materials, like 45% of the portfolio anyway. The biggest shortfall would probably be that you're more exposed to mid and small cap companies, but all of those things could obviously be a positive. You're exposed to more growth, you've got more diversity of companies, you've got greater diversity of sectors. So that's a non-answer, isn't it? Yeah, I should.
No. Well, they asked for the shortfalls. You said shortfalls are you get more small cap exposure. Some people don't like small cap exposure, so.
And then because Australia is so undiversified, the other one was there's not a lot of exposure to future growth sectors like IT, health, and consumer.
Yeah. I think we're both talking about the same. We're both thinking of the same ETF. That does equal weighting.
I actually use it within portfolios because it's great to kind of reduce the concentration in a index core portfolio.
Yeah. Agreed. It gets a lot of awards, that ETF. We're talking about the MVW ETF, by the way. I haven't really, because it's still got the kind of the same industry exposure. Yes, different companies, which is great. It's got the same industry exposure. It doesn't really do what a lot of people think it does, which is diversify away from the banks and the financial sector. So it can be used to I think that's what you're going to say. Like it could be used that way. But for me, I would want an actual small cap exposure. Like I'm more of a pure exposure if that's what I wanted to do. I wanted to control it myself. Good ETF. no issues with it being in a core or a tactical part of a portfolio from where I sit. Final question comes from Alex. Oh, actually, there's a follow-up from Rodney.
Yeah, I miss that Rodney. He's always pulling me up on
he said
on what I miss. Well, we mentioned
more
this.
rebalancing with equally weighted versus market cap could lead to more capital gains being distributed. It can.
The general rebalancing rule is that it sells more of the winners and buys more of the losers. So correct, exactly right. You may get more capital gains in your distributions than income.
Yeah. So that's because it's also this ETF in particular, the MVW has around 100 positions. So you're going to get more trimming of those ones that slightly go out of balance than say if you've got the Vanguard VAS ETF that has 300 positions. It can kind of let BHP ride up and down. So you're not going to get that constant churning. And for people in a higher tax bracket, that's the key consideration, as Drew said before, too, with the small cap exposure. Thanks, Rodney. So Alex is the final question that we've got to get to today, Drew. Alex says, I'm relatively new to ETFs, keen to invest in the NASDAQ Top 100 as it feels it has the right risk-reward profile for me and my family. Thank you for considering that yourself, Alex. A lot of people don't put that in the question. I was going to go with the Betashares product, NDQ. However, at the last minute, I looked around and found the Invesco product, QQQ is the ticker symbol. I assumed they would be very similar. However, Betashares management fee is 0.48. I think is that right? 0.48 versus the Invesco fee, which is 0.15. Seems like a no-brainer to go with Invesco. Is there anything else I should be considering or watching?
Yeah, I think one would be QQQ is not listed in Australia, so you're buying it via an international trading platform, whichever one that is. So then you've obviously got, I think they're both unhedged, so the currency isn't necessarily an issue, but you're going to have any reporting requirements, tax reporting that comes off distributions by QQQ. Ultimately, you're buying the same thing, as you said, and you generally think it's cheaper to buy a better option to buy the QQQ. But depending on your tax implications and the reporting that you have to do, holding a US stock would be the biggest challenge.
For me, it's you actually brought up something really important in your prepared remarks here, Drew, which is that when you transfer from Aussie to US dollars, so say, for example, you got a brokerage account and you transfer the money across, a lot of those brokers offer you really crap FX spreads. So that means that like when you transfer your money, Alex, from your Australian brokerage account,
Rodney's on it again.
Yeah, Rodney's got it too. They charge an arm and a leg. A lot of these brokers actually make most of their money from you going back and forth between currencies. They just kind of like clip the ticket as you go through. Whereas at least when you got the Australian ETF, it's Betashares managing that, which is tends to be a lot more efficient. So,
so the spread on Forex could be 0.1, 0.2 that you don't know about. Even more, that's it. Essentially. So maybe the fee is fair on that.
And then you've got the added bonus of it, like not having to fill out the tax form, the W8BEN form, which is just a pesky thing you have to fill out every few years. So for me, I'm just quite happy. I say this to a lot of people. I'm just happy to own ASX listed ETFs, happy to pay a little bit more and just go with that, to be honest. I think it just makes a lot of sense.
I got a last question for you as well.
Oh, here we go. Throw it at me.
What's excited you this week, and what are you most worried about?
What's excited me?
Investment markets.
Okay, I was going to say, let's clarify that. No, so what's most excited me? I don't know. I feel like some technology companies have actually bounced a bit this week. I don't know if you've noticed that, but particularly Australian companies have bounced a bit. And that's really interesting. One of the things that, obviously I said that before that I was with LaserBond in Sydney, and that episode's not due to go live to the public with Wayne until a couple of weeks. But they told me that the AGM's coming up and whatever, and that was due out today. And they actually came up with the AGM today and said, I think just off the top of my head, that their first quarter revenue was tracking 36% higher than last year. So that's not sustainable for them, just so we know. And there's going to be costs that come into that mix through inflation in steel prices and whatever. But I thought that was a really promising start. So that's kind of got me really interested. I come away from that interview, maybe it's just like the bias of management, but I come away being like, why the heck do I invest in companies that aren't founder or family run? Like, why do I even bother? Like when I can just invest with people like this. So that was probably where I got a bit ahead of myself. But what was the other part?
What are you most worried about?
I'm worried that I'm worried about the US dollar, actually, funnily enough. We talked about this.
Not worried about getting older, or?
I was losing a lot of hair very quickly. So that's just, it's probably like part of this. But no, I think the US dollar has ran very hard. And so a lot of my companies are exposed to that as a beneficiary of that. And even some of my ETFs being unhedged. So I'm actually worried about that shifting. I don't see it shifting anytime soon. Like, I think, just as a thumb suck, I have no skill at this. Maybe US rates go higher, which keeps the pressure on. But I just think that's an active thought in my mind. I could get that wrong, and it could really reverse on me in a big way. So that's something I think about. What about you? What are you excited about? What are you worried about?
Term deposits.
But is that for both of those things? Or?
Well, we're meeting clients at the moment that have sold property, or they've sold a business, or they've got cash they want to invest. And you go, yes, there's so many things on the horizon. You've got, Ukraine, you've got inflation, you've got bond yields. And then you go, you compare to 15 months ago. If you sold a business 15 months ago and wanted to invest it, you were getting 0.5% on term deposits, 0.5 in government bonds, and you were buying an equity market that was at all-time highs. Now you can realistically put money into a term deposit and earn close to 4%. It's kind of
happy days.
It's kind of, yeah. And then the other one would be not necessarily the US dollar, but the certainty with which people are forecasting at the moment. We've seen no one can forecast anything correctly for the last 5. There was a session in Noosa as well, which was just a folly. They brought up all the folly of forecasting. The Reserve Bank, every central bank couldn't even forecast their own policy correctly. But yet we tend to try and build investment strategies on, forecasted a certainty.
Yeah, I don't know. I can get in like a lot of digital fisticuffs with people over this because like people that try and forecast macro events, it's just like I need to stop now. So like I score good, have a view, and I love hearing from people. I love hearing diverse perspectives. Like Craig brought that to the show this week. Brilliant. And we've got a bunch of others that are coming up that are different again. But yeah, I mean, there are some things you can control. A term deposit that you lock in is one of those things. So I feel like that's really really interesting. Hey, as Eddie's just popped up and said, I have a different view on founder-led companies. I do agree they tend to be better as a group, but I think they stagnate in performance. Changing them to someone new with new ideas is really hard, but yeah, I guess it depends as well on the industry. Agreed, like it does. That's why Zeddy mentioned the risk of a CEO having 65% of a company. And we saw this with Mark Zuckerberg in the United States. He doesn't own 65% of Meta, but he has the different class of shares. So that gave him like a lot of sway. And yeah, so that's an issue. You kind of like ride or die kind of with the insiders at that point. So yeah, it's really interesting, Drew, that the folly of forecasting. I mean, it happens all across the spectrum, whether you're bottom up or top down. So we're not going to make any forecasts other than this one. I will be appearing at the Australian Shareholders Association in October. If you want to get a pass to the Australian Shareholders Association Virtual Summit, I think it's only $60 or so. Huge lineup. I am definitely the odd one out. So if you want to come along, I'm doing a talk on ETFs.
Will you be wearing your Hawaiian shirt again?
Hawaiian shirt. That would be very much appropriate, I'd imagine, with the Australian Shareholders Association crowd. I doubt it, but I'll probably try and wear a shirt of some description. But if you want to come along, there will be a link in the show notes. So please check it out. The guys at the Australian Shareholders Association do a great job. In the meantime, Drew, thank you for joining me. We'll be back next week with 2 cents. Ask your questions on the Rask websites. Get in touch with Drew, wattlepartners.com.au/contact. Brilliant financial planner based out of Melbourne. Services clients across the country with partner in crime and partner in advice, Jamie Nemesis. So, mate, thanks for joining me.
Thanks for having me again.
And thanks for everyone that tuned in live. Really appreciate it.